Couple of final comments on the statement of cash flows. One is that the format is going to look something like this. So this is a nice summary slide that shows you all the things that impact the statement of cash flows. In our operating section, we're using the indirect method. So again, to reiterate, we start with step 1, start with net income. Step 2, add back non-cash expenses. Step 3 is dealing with your gains and losses. Step 4, assets opposite. Step 5, liabilities the same. And then step 6, add it together and you get your net cash flow from operating activities. Investing is going to deal with buying and selling long-term assets, including property, plant, equipment, and investments. Financing is going to deal with borrowing and repaying money to the bank and issuing our own stock, buying it back, and then paying dividends. And then when all is said and done, the point of the cash flow statement is to tell us why cash changed by the amount it did, and the ending cash on the cash flow should equal the ending cash on our balance sheet. 2 additional required cash flow disclosures would be any non-cash investing and financing activities, like buying a building with a mortgage. That would be a loan. So we're getting a building, we're increasing our long-term assets, but cash isn't impacted because our long-term debt is also increasing. So we would disclose that, basically to explain any differences that aren't accounted for on the cash flow statement itself. And then if we're using the indirect method, we also need to disclose the amount of cash we paid for interest and income taxes, because that won't show up on the face of the cash flow statement using the indirect method. Let's talk how we would do the direct method. I do not care for the way the book presents it because it means I have to learn new things and I don't like that. Basically, I will convert the way the book does it to the way you've already learned using our friend Owls. Assets opposite, liabilities the same. With the direct method, basically all we're doing is converting each revenue or expense into its cash flow. So with sales revenue, you're going to start with sales revenue, and then you're going to do your assets opposite, liabilities the same with the related accounts. So here we have accounts receivable. That would relate to sales revenue. So we do assets opposite, which means we add decreases in current assets and subtract increases in current assets. You have to know what current asset relates to revenue, and that's going to be accounts receivable. In addition, there could be another account, a liability that relates to revenue, and that would be unearned revenue. If that were involved, we would do liabilities the same. We add increases in current liabilities and subtract decreases in current liabilities. So the only other related account here could be unearned revenue. So you should be aware of that. Most of the related accounts are slap you in the face obvious, which we'll talk about in a bit. But for revenue, it can get a little tricky because accounts receivable, you have to remember, is the result of selling things on account, and sales is the same as revenue. Unearned revenue has the word revenue in it, so that should be a clue that that also relates to our revenue account. With interest and dividend revenue, we do the same thing. We are going to add decreases in current assets and subtract increases in current assets that relate to interest or dividends. The primary and only accounts I can think of that would relate to interest and dividend revenue would be the interest and dividend receivable that they're showing here. And you can see assets are opposite. We're adding decreases and subtracting increases. When we move to expenses, in order to keep with assets opposite, liabilities the same, you have to make your expenses negative. That's the key to my method. Then you do assets opposite, liabilities the same. So basically I'm going to switch all of these to be assets opposite, liabilities the same. So the related current assets that go with cost of goods sold are inventory. So if inventory goes up, the opposite of up is subtract. If inventory goes down, the opposite of that is add. And then the related liability would be accounts payable. When we purchase inventory on account payable is affected. So liability is the same. That means we add an increase and subtract a decrease. So again, we're adding increases in current assets, subtracting decreases. I'm saying the wrong thing. We're adding decreases and subtracting increases in current assets because we're doing the opposite. And then we're adding increases in current liabilities and subtracting decreases in current liabilities, which goes in the same direction. And we're going to do that with all of our expenses. So we start with the expense as a negative. It should make sense it's a negative because it's going to result in a cash outflow. And then we can do assets opposite liabilities the same. So we get rid of all of these pluses and minuses, and we're going to do opposite. So prepaid expenses are current assets, so we're going to subtract an increase, add a decrease, and then accrued expenses are current liabilities, so we add an increase and subtract a decrease. With income taxes, the prepaid income taxes is a current asset, so we subtract an increase and add a decrease, assets opposite, and then liabilities the same, we add an increase and subtract a decrease. So I like knowing AU's assets opposite liabilities the same, and it'll work for the direct method as long as you make your revenues positive and your expenses negative. Then you add decreases in current assets and subtract increases in current assets that are related to the account we're converting. So when I said earlier it's slap you in the face obvious, the examples I was thinking would be like interest expense goes with interest payable, or utilities expense goes with utilities payable. Interest revenue goes with interest receivable. Rent revenue goes with rent receivable. So they're very, very easy to connect. And then with liabilities, we go in the same direction. So we add increases in current liabilities, subtract decreases in current liabilities. So again, if you make your revenues positive and your expenses negative, then basically here's a summary of what you would do. You take your revenue as a positive, your expenses a negative, and then you do step 4 and 5 of the indirect method. You add decreases in current assets, subtract increases in current assets, add increases in current liabilities, and subtract decreases in current liabilities. On the expense, you do the same thing. Add decreases in current assets, subtract increases in current assets, add increases in current liabilities, and subtract decreases in current liabilities. So if you approach it this way, then it's always assets opposite liabilities the same. You don't have to skew your brain and make it more complicated than it needs to be. Last thing we're going to talk about is how do we deal with gains and losses. They show a big journal entry for this. I think it's just easier to do the formula. Sales minus, or the selling price, minus the book value of the asset equals the gain or loss. Book value, remember, is the asset cost minus accumulated depreciation. So it says if property, plant, equipment with original cost of $10,000 and accumulated of $4,000 is sold for $8,000 in cash, the following entry is made. So what we would know is on our income statement, we would know we had a gain of $2,000, and then we would know that our asset went down, the net amount of our asset went down by 6, which is the book value. And then what you'd effectively be doing is solving for the selling price to put onto your cash flow statement. So something minus 6 is 2. That's how we would get to our selling price, which is 8. So basically, if you have a gain, you take the book value, the amount of your asset that decreased, and then you add the $2,000 gain in order to get the selling price. If you have a loss, you would end up subtracting the loss to get to the selling price, which should make some logical sense, because if you have a gain, it means you got extra money above and beyond the book value that you gave up. If you have a loss, it means you got less money compared to the value of the asset that you gave up. And that, my friends, is the last official lecture of the semester. As always, please use Canvas to have the additional resources available, the additional practice problems, as well as Connect. There's additional problems on there that can help you better understand the material and practice it. Please reach out to the discussion boards if you have any questions.